From our Nashville, Tennessee studio, I'm Al Dominic. Welcome to Looking Ahead, a series designed for top executives and their boards looking to get smarter, faster on emerging issues and opportunities. Today we're talking about the rapid consolidation and technological changes taking place across the financial sector. Joining me from New York City are David Inglis and Stephen Amdur, partners at the law firm of Pillsbury Winthrop. The two advise clients in the financial services industry with a particular focus on deals involving banks, non-bank finance companies, specialty lenders, fintech and payment companies, private equity and other investors in this industry. So, gents, nice to see you today.
Nice to see you.
Hope you're ready to roll. I've got about 5 questions I want to go rapid fire that I think you're going to do awesome helping us better understand. And I'm going to kick this to David to start because it feels to me like we're at this generational shift in terms of technology and the banking sector. Curious if you agree, and if so, how you see things changing in such rapid fashion.
Yeah, I do agree with that statement, and I think there is a very rapid shift going on. It's been going on for years now, but technology is really being implemented and radically changing the way financial services, banking services in particular, payments are delivered. And we could talk about a whole host of different things that are happening, but just to pick one to focus on, one thing we've seen recently more and more, and it's evidenced by what we've seen. One private equity firm in particular do is they've made a couple of investments in platforms or applications, I guess, that are tailored towards delivering services, both payments and non-banking services, to a specific type of end user. So one was geared towards college students, right? And it has a growing customer base, and they provide not only a payment solution on that app for college students for things like the meal plan or their tuition or books at the bookstore, but also access via their student ID to events or to buildings across campus and other types of informational management services. And the other was a cloud-based software solution for ministries and churches, where again it has some payment aspects to it, to help manage things like donations to the church. But then there's a huge information component that deals with the broader types of informational needs that parishioners have for the church in question. So you're seeing end users prefer to get the payment aspect together with other services and apps that really provide a full suite of services to the end user. So it's an unbundling a little bit of what's happening in banking.
Yeah, I mean, it's a fascinating time. And Stephen, I'm curious if you'd like to build on what David just said about, kind of why you see this generational shift taking place and really, again, what you're seeing.
Yeah, that's a great question, Al. I think, practically speaking, the cost of development has gone down so much lately, and the ease and access to private capital, whether they be third-party capital from venture capital or private equity firms, or strategic investments from the banks, who are realizing more and more and more that they need to be investing in new technologies in order to keep pace. It's really created just a dramatic opportunity for entrepreneurs and builders to come up with new technologies that fit in really well to the existing ecosystems and provide better services to end users, whether those end users be the individuals, the students, the parishioners that David just mentioned, or whether they be the larger financial institutions who are finding themselves with sticky problems that fintech is really well suited to fix.
Yeah. And so when we think about fintech, there's so many different ways that people can approach this. But, since I've got the two of you here with me remotely, thought we might divide it into 2 categories. So one could be considered where there's a new or a brand new way of doing business. Maybe another is where technology helps to do existing lines of business better. So again, I'm curious to get each of your take. David, I'll give you the choice of which of those 2 categories you'd like to focus on first.
Yeah, I mean, I think you're right. I kind of think of it as maybe more of a spectrum where on one end of the spectrum there are, products that have been developed or, processes or ways of doing things that have been developed in the fintech space that are so radically different that you could consider them as, a brand new way of doing business. I mean, the example that comes to mind most quickly is something like Venmo or Zelle, right? I mean, these are fintech products where what do we do when we had to share funds between human beings? Either gave you cash or we wrote you a check. There really wasn't many other options. Now you can't even list on one hand the different ways that I can transfer funds to you in a matter of seconds, and the degree of precision and the ease with which we can do that. It just radically has changed the way individuals, exchange money between each other as individuals. And you're going to see service providers adopt those means too, right? So like if you have a personal trainer or someone that's functioning as an individual, they're likely to use those kind of payment platforms more person to person. So it's really expanded that as well.
Yeah,
The
I like how you
interesting thing
think
about that, right? Go ahead, I'll start.
No, I was going to say I like how you think of it on a spectrum, but I wanted to ask Stephen if he wants to kind of take a look at one of those two categories, if you will.
Yeah, look, I think not to reject your premise, but I agree with David. It's a little bit of a spectrum. Even though I think I agree with the premise on a broad spectrum of you're seeing things like blockchain come about. You're seeing people try to come up with new ways of talking about technology, talking about financial services, talking about communication, payments. But many of them are just new ways of building on the existing technology that we use. Whether you talk about Venmo as a replacement for the traditional way of two people splitting a check and putting the cash down or otherwise, or you talk about blockchain technology for real estate that's going to try to replace title insurance. Either way, you're using the technologies, even if you're creating brand new ways of doing business. Much of it is in a way of reinventing the ways in which people have been doing business for generations.
Yeah, and I'll just touch on the other end of the spectrum, which I think probably more instances of fintech disruption are happening on the other end of the spectrum, which is kind of making it easier to do specific types of financial services. A good example of that is the recent acquisition by a couple of banks of business-to-business payments platforms. And what both of those banks said, I think it was KeyCorp and maybe US Bancorp. I think what they said was, it sort of completes our suite of services, for small businesses. And it's a way for them to better complete their offering, not lose aspects of that business to other providers, and keep those customers in house because they're providing them treasury and deposit accounts and loans. But payments is an important part of that, and payments again is one area where the technological aspects are starting to outstrip what banks have traditionally done. So bringing that in house allows them to continue to stay ahead of the game, for those kind of customers.
Yeah, and we're talking about a massively important industry, one that really impacts every single American's life, pretty much on a daily basis. So, I'm curious as we're talking about this inflection point that we're at, as people recognize across multiple industries that the financial sector is going through this really interesting time of change. There are different concepts that people like to discuss. Stephen brings up blockchain, the whole decentralized finance, category. That's worth a whole another episode of looking ahead. But I'm curious about some of the bigger problems that might be getting fixed in smaller ways. And by this, I mean, if you're thinking about fintech as a technology solutions provider that can bring a simpler type answer to a question or an issue that may have in the past been seen as significant, if not downright daunting. How do you interpret that type of logic for your clients?
So I'll jump in. I think the response to that is really going to depend on who the client is, right? I think a number of questions and issues that seen some of the larger financial institutions have over the years is many of them have been assembled through a series of mergers, through a series of new developments and new product lines, and new service lines over the years in a way to make it really hard for the individual systems to work together the right way. And what you're seeing, whether it's something like BlackRock's Aladdin or some of the new core technologies that are being built, people are realizing the issues that can come about when the internal systems just don't talk to each other as smoothly and as efficiently as they should. And I think what we're seeing now is a number of different banks and financial service firms working exclusively on trying to improve the core technologies of their back office systems, make those functions work more smoothly, and try to eliminate some of the friction that happens when the different lines are trying to talk to each other, because that's where you really can run into some big issues.
It's a great point. And, when you think about some of the past acquisitions, it's hard not to think about the business of banking and how over the last 10, 15 years, like the real catalyst for most institutions' growth was buying another bank. Now it seems to me that there's opportunities to maybe not look to buy another bank, but to potentially buy a tech company of sorts. And so, I've made note of Fifth Third in the last year and a half has made some really interesting acquisitions of health tech type companies. That's just one example of a bank that is venturing into some new ground to support its customers and constituency. So I've been thinking, if I'm a bank looking at acquiring a technology company, what do you guys think? Should I be looking in the wealth tech space, insurance tech, somewhere else? Can you help us think about that question? David, I'm looking at you.
Sure. I think you're right that especially with the larger banks, the money centers, the super regions, we're no longer looking at, banks buying banks, right? There are still some that want to grow. They, want to grow their deposit franchise. Most people are now focused on how do I deliver my, my services and my products, and how do I not lose market share? Fifth Third's CEO had a statement out recently. I'm sure it was a couple of years ago now that he literally said, I'm afraid of fintech. It worries me. We need to get ahead of this game. And I think they see themselves as potentially losing franchise. Payments has moved away completely from banks in some ways, right? So, and what they don't want to lose are things like lending, right? That's a big deal. So, Fifth Third's not the only bank, just to use this healthcare as an example, that has gone out and bought a healthcare platform in recent years. eCorp did it, and they did a similar purchase. I think theirs was focused on refinancing of student loans, but with a specific marketing effort to doctors, dentists, and other professionals. Fifth Third's, I think, was more about funding startup costs for entry-level people in those fields. But both are trying to capture and keep that sticky professional customer, because they want that customer in the bank. They don't want to lose them because they're going to get a mortgage, they're going to have kids, they're going to have 529 plans, they're going to have wealth management business. And if you see that customer walk away and they're now getting their services through a fintech, right, you got to find a way to recapture that. So I think those were all kind of ways to guard your flank and keep those customers with the bank that down the road can offer a lot of products and services to fully meet their needs.
Yeah, and I think the interesting part, right, is when you think about sort of the strategic opportunities and the risks that banks are facing today. David's focus is a great one, and it's talking about where they're at risk for differentiated service offerings that are being attacked from the fintechs. I think the other key point to think about is the user experience, right? If you think about something like Robinhood, something that Robinhood offers that you couldn't get today from any number of different opportunities, but it had a better user experience, it had a more intuitive design, it had a better targeted reach towards a new universe of customers, and it was very successful. And if you think about where banks are going, what strategic opportunities and risks they're analyzing, I think it's important for them to think about, am I at risk of losing customers because there's a different service offering that somebody's able to provide, or is it somebody's offering the same service offering that I'm offering today in a more attractive fashion? And the difference between those two is going to, I think, drive a lot of where they're trying to go with their strategy and how they're trying to protect their.
Great points. And as we wrap everything up, I just want to say thanks to David and Stephen helping us go through these different concepts about banking, technology, and the intersection of the two. Again, I'm Al Dominic, and I'll see you on the next episode of Looking Ahead.